Hey guys, Florida Real Estate Sales Associate Course, Chapter 14, The Pointers. Real estate related computations and closing of transactions. This is a very visual chapter. There's a lot of graphs and charts involved. It's best if you look at it, reference the book, or you can Google the PDFs. But it's very visual. Entries are identified in the seller's and buyer's statements as debits and credits. The easiest way to understand debits and credits is to consider them in relation to a checkbook. In a checkbook, a debit occurs when a check is written and the amount of the check is subtracted. The credit occurs when a deposit is made and the amount is added. To understand a closing statement, simply think of debits as money a party either must pay or won't receive on the day of closing. Think of credits as money a party will either receive or doesn't have to pay on the day of closing. The use of debits and credits simplifies the process of arriving at the final amount due from the buyer and the final amount due from the seller. Please remember that the closing statements reflect the financial relationship of the seller and buyer as of the moment of closing. Prorating examples. Rent. Rent is usually paid in advance. The monthly rent was collected by the seller and must be divided equitably between the seller and the buyer. The seller is entitled to retain only that portion of the rent covering the period of time the seller owned the property. The seller is debited for the amount of rent that applies to the buyer's period of ownership. The buyer receives a credit for that amount. Prepayment of interest. A prepayment, as the name suggests, is money paid in advance. A prepayment is not the same as a proration. A proration equitably divides an existing obligation between the party. A prepayment is a new obligation created at closing. Many lenders want all payments to be due on the first of the month. If a closing occurs on any other day than the first, interest for the balance of the current month must be prepaid. There would be no payment due on the first of the month following closing, since the interest normally paid in arrears was prepaid at closing. When prepayments are required, the day of closing is always charged to the buyer. City and county taxes. Property taxes are paid in arrears. The seller has paid no property taxes for the year in which the sale occurs unless the closing takes place after November 1st and the seller paid them prior to closing. Only one tax bill per year is mailed, and that is sent to the owner of record on November 1st. The buyer will receive the tax bill for the entire year, even though the buyer did not own the property for the entire period. Therefore, the seller is debited for property taxes based on the period of the seller's ownership, and the buyer is given credit for that amount. If the seller has paid the taxes prior to closing, the seller will be credited and the buyer will be debited. Expenses. Expenses are debited either to the seller or the buyer. All entries in this section are single entry debits only. Abstract continuation. The seller would normally be expected to provide either title insurance or an abstract accompanied by opinion of title as evidence of marketable title. State documentary stamp tax on the deed. Before a deed can be recorded in the public records, documentary stamps must be purchased and affixed to the deed. Stamps are purchased from the clerk of the circuit court, usually when the deed is presented for recordation. Currently, the tax on the deed is calculated at the rate of 70 cents per $100 of value, or fractional part thereof. Based on the sales price of the property, the tax rate in Dade County is only 60 cents rather than 70 cents. In the absence of any agreement to the contrary, the seller will be responsible for payment of the state documentary tax on the deed. State documentary tax on promissory notes. The state documentary tax on promissory notes is calculated at the rate of 35 cents per $100, or a fractional part thereof, on the total amount of the note. The state documentary tax on the note is paid on both new and assumed notes. This tax is not payable if title is taken subject to the mortgage. The buyer usually pays this tax. State intangible tax on mortgage. The state intangible tax on mortgages paid on all new mortgages only. New mortgages only. State intangible tax. The state intangible tax on mortgages is calculated at the rate of 2 mils, which is 0.002, on the total amount of any new mortgage. The tax is not payable when a mortgage is being assumed or title to the property is taken subject to the mortgage. The buyer usually pays this tax. This tax is not paid on assumed mortgages. The tax is collected when mortgage documents are recorded on the public records. Tax is payable in real estate closings. Tax rate. State documentary stamp tax on deeds, state documentary stamp tax on notes, and intangible tax on mortgages. State documentary stamp tax on deeds is 70 cents per $100, or fractional part thereof. State documentary stamp tax on notes on promissory notes is 35 cents to $100, or fractional part thereof. And intangible tax on mortgages is 2 mils, which is 0.002. State intangible tax on mortgages only when it's a new mortgage. Providing marketable title is the responsibility of the seller. Okay, and that's it. I suggest that you look over the closing statements. Like an example of a closing statement, you could probably just Google it. It should come up right away. There's seller statement on the left side, and a debit column, a credit column, total purchase price, and the middle column has all the different credits and debits, and then the right side is the buyer statement, debit and credit. That's it for chapter 14.